Hello, so welcome everyone. Before we start, I just want to go through the purpose of this entire YouTube channel and the purpose of the video itself. There's a lot of education available on Twitter via my threads, via other people's threads, and there's also a lot of YouTube videos available. So why do I need to do this? In the midst of all of that, there's not really a lot of useful education. So, we can skip the technical jargon, we can skip the stuff that you don't really need to use, and then just focus on the actionable stuff. So, I want to make this an educational pursuit and also include a lot of market updates at the same time. So, we'll start with some basics, then price action, volume profile, fibs, waves, VWAPs, order flow, open interest, delta, footprint, bid ask, depth of market. I usually use in my day trading all of these, like a combination of all of these in some form. So before we get there, I want to educate you about what it is, how I use it, and then we can combine all of that to teach you about a trading system. Now, for the purpose of this particular video, I want to talk about three different things. What are the different types of market conditions, how to identify those conditions, and the types of discretionary traders. So let's get into it. So what are the types of market conditions ideally? Now, there's ranging market conditions and trending market conditions. So for ranging market conditions, you usually have your range high, you have your range low. Now, price can approach this from higher or lower, does not really matter. So in this case, price is coming from the low towards the high, testing range lows, and then chopping somewhere in between. The same thing could be true if price approached the range from higher up, and then we formed a similar pattern. Okay, now most of the time, if not all of the time, markets actually range. So price moves impulsively, but then when you actually zoom out, you'll see that markets have an uptrend and they have a downtrend. Now, an uptrend is usually characterized by a high, low, a higher high, which is above this high, and a higher low. Now, there's many ways to describe a trending market. I generally try to be very obvious about it. If it's not extremely obvious, then there's no point in viewing this, and we'll see this on the chart at some point. Now, same thing for a downtrend. You have a low formed, and then you have a high, a lower low, which is lower than this, and a lower high, and then when price caps, and then it goes, it continues down in the same manner. Now, what's important here is how you define a trend. Now, sometimes you will get a price action as in you form a high, then you form a low, and you don't really form another higher high, but you form a higher low, right? And then price does something like this, right? And then something of the sort. Now, a lot of people consider this to be like a higher low. So if you're really inclined, well, you can call this part a higher low if you really want to. But in my opinion, that's not how it works. Okay. The reason is that unless you have a higher high, you cannot have a higher low. Okay, for me, this is a range. And the reason I say range is because price formed a high, this is your range high, and price formed a low, this is your range low. Everything in between is just a range, right? Once we sweep range lows, we can target the range highs, right? And then once it breaks back above, then if we zoom out to a higher time frame, we can probably see this as the same uptrend that we saw. And all of this price action in the middle will relate to something in the middle here. All of this can just be arranged like this. Now, what do I mean on the chart? Okay, so let's take a Bitcoin chart and just go into any random situation. This is our bear market lows. We are on the daily chart, and obviously it will not be as clean as arrows, right? If you take an arrow, it'll always be super clean, and but that's not how the market actually looks, right? So in this case, we can clearly see that price was actually downtrending. This is a very clear downtrend where you had highs, you had a low, lower high, lower low, lower high, then we broke down, lower low. Okay. Now, in my opinion, most of this can be characterized as a range on a relevant time frame, and it can be characterized as a trend on a similar timeline. Okay, now what do I mean by that? I usually try not to look at market as ranging versus trending, but I try to boil everything down to a range. Okay, now this is, let's say, your range high, this is, let's say, your range low. So price formed a low, price formed a high, this is your range low, this is your range high. Everything that happens in between is just ranging conditions, right? And then we can get into how we want to trade this, like we want to short this, how do we do that? If we want to long any of this, how do we do that? We'll get into that. Okay, for now, what you have to understand is most of the times markets actually range, and then really small percentage of the time we have these impulses. Okay, I call these impulses. Now this is not formal price action education, but this is what the way I see it, right? So most of the time you'll see the market doing something like this, then this, and this is what an uptrend actually looks like, you know? And in terms of downtrend, we just have this in inverse. So prices normally go sideways for a while before they go up or down in very few candles. Now here you'll realize that we actually did something similar. Now price formed this low, and we were technically in range for about 266 days, right? Now this is a very wide range, all right? So now this is like 30% value. You can also look for smaller ranges. In this case, they could be something like this, right? There's not a very clean range, but you can still call this one much smaller range. This is around 63 days, and the price difference between these levels is around 13%. Still pretty large, but you know, price is fractal. You observe these all the time, and that's not really what we're here to talk about, are we? Right? So what I wanted to talk about was that once you have your low, once you have your high, and then you have a deviation of the lows, price goes below the range low and then comes back up, and then you have this nice sort of momentum going for you. Somewhere around here is when you want to start looking for longs. Now you can be very rigid about this, or you can be really cool about this. Okay, now what do I mean by that? If you think about it, we had this low. Let me just make it as accurate as possible. Yep, so we had this low, and price closed above that low right here. But then we had this kind of wick above, then we moved down anyway, right? So if you were going to long here and then target the range highs, that you were going to get stopped out. And that happens, you know, that's trading. Being wrong is part of trading. So when the same thing happens here, where you actually close above, right, you can do the same thing, put a stop loss below these lows and target these highs, which is actually really good risk reward, and it's actually one of the trades that I took. But I didn't actually take it up here, I took it up here, and I was really generous with my stop loss, which was a spot play, and then you can target the range highs. This is still, you know, 2.46 R. So this is what a range is, and if we talk about trending market conditions, it's about the same. Let me just clear the chart up a little bit, and about the same. Well, in the same chart, you can actually clearly see what I mean. You know, if we go up, let's say, to the 3-day time frame, well, this is clearly like a choppy period for the market, right? This is a ranging period for the market. But once we got back above this high, which kind of formed this low, right? So once we got above this high, that is when you can see the uptrend actually forming. And even if you're late to it, it doesn't really matter. A lot of people think, oh, I missed the train, price shot up without me, and I've missed the train, but not really, because when price actually, Bitcoin is a very reflexive asset. What do I mean by that? I mean, when it goes down, it tends to keep going down, and when it goes up, it tends to keep going up. Okay? And we'll talk about why that is later. For now, what we can actually talk about is market structure and this nice little move we had here, right? So we had this high that formed our lows, and this was actually a really clean retest level later on. So we had this high, we had this low. When price broke back above this high, it actually came back down, and now this is just like a support resistance level. So now you can say that we have had a switch or a change in market structure. You can actually, this is what people call a market structure break. So you can have this kind of stuff here, and this is where the trend actually started. And you had like low formed, maybe you can, this is like really marginal. So depending on how you want to look at the markets, you can call this your high or you can call this your high. Then after that you had a higher low, right? And same, this is everything that happens here is just a range in my opinion. So market ranged here, impulsed up, ranged here, impulsed up, ranged here, impulsed up, is ranging here, or just kind of, now we have sort of like a downtrend. So my entire point for this is for you to understand how markets fundamentally work. And if you just look at the price history, fundamentally we're always ranging, right? On some time frame we're always ranging, and what you want to do is look at markets as ranges where positions are built up on either side. The reason we range is that positions are built up in this period. This is a really long period of time. Now this exact period of time is around 207 days again, after we had 272 days of range right below that. Okay, now in this period you have a lot of positions building up. You have a lot of longs and shorts playing out here, a lot of longs and shorts playing out here again, and then one side. Now if you want this impulse up, this is usually because either a lot of shorts built up in this range, then suddenly they got blown out by some spot demand, some aggressive market buying, or a lot of Bitcoin was distributed here via spot and then they just ran out of it. Okay, so these are the types of market conditions, and now I want to talk a little bit about the types of traders. Okay, now the types of traders, let's get into it. There are either range traders or you have mean reversion traders. Okay, in discretionary trading usually we just have these range traders, and then we have like our mean reversion traders, and we have our trend traders. Okay, so range and mean reversion kind of like the same thing, right? So you can either see the market as a range, or you can see the market as a trending entity. Okay, as I said, you can either view this as a range or you can just go down a time frame. Okay, let's go to let's say the 4-hour time frame, and then you can just go ahead sorry about that. Yeah, you can just go ahead right down here, and in between you can actually go for a lot of trends here, right? You can actually say that this was the high made by this low and we broke that, right? So this was another high, this was another higher low, and then we broke that again, we did that again, and we continue doing that. Or you could see all of this as a range. What do I mean by that? You could see this as a range which broke up, then you can go ahead and see this as a range, and like just to show you that I'm not actually bullshitting you, this actually makes sense, right? So if you see these things as a range on the lower time frame, this is the 4-hour time frame. So you have the high, you have the low formed, you deviate the lows, deviate the highs, chop around mid range, impulse up. Okay, same thing around here. You form the high, you form the range low, sweep the range high, retest that level a couple of times, go back below range low, go back to range high. You just you have these range levels and you're just oscillating between them and taking like a deviation from either side. And once you deviate the top of the range, you can target the range lows. Once you deviate the bottom of the range, you can target the range highs. And that's just how it works. Okay, so you can view it like that, or you can view it as a trend trader, where you want to say that, okay, if the market is in an uptrend, I'm going to trade it. If the market is in a downtrend, I'm going to trade that. So in this case, you would have taken this breakdown here as a downtrend, and once you have this, you are going to try and short this, and you're going to try and cover this, short this, and cover this. So essentially you're taking, or you want to be taking, the same trades. It's just about how you look at the market, right? So mean reversion traders, they would ideally try, let's say you consider this entire move a range. So if you're a range trader, you would probably have shorted this, you would have tried to long this, you would have shorted this, not really sure if you want to do something here, and then you would have tried to short this as well. But after 2 successful shorts and 1 successful long, you would have been wrong here. You would have hit your stop loss, and then you would have waited for price to do all of this without you, right? Or maybe you just took this long, held a little bit of it, and then tried to ride that long with a trailing stop loss. A trend trader usually benefits in these conditions, where if you broke out above this high, so this was the high, this was the low, you broke out above it, they would ideally long here and they would ride this entire trend up, right? And here, when range traders actually became more profitable again, let's just say that this was your range for a while, so range traders actually became profitable, as in they would have shorted this, trend traders would have long this, they would have, a range trader would have long this, a trend trader would have kind of considered this a breakdown and tried to short this, right? So it's just, both of these things work. You can do a combination of both, or you can choose what works for you. And that's why I wanted to talk, as the final thing in this video, that's why I want to talk about the types of traders, right? So trend trader is things that move down will continue to move down, and vice versa. And things that move up will continue to move up, and vice versa. Same thing we talked about. Range traders, they see markets as small ranges. Markets range 70% of the time before impulses, right? On the actual chart, the impulses that we were talking about are the same. Like, this is an impulsive move, this is an impulsive move, and usually this is when range traders are probably flat, unless or until they're on a really low time frame and they're trying to find ranges all the way up or down, okay? Now for mean reversions, they're the same as range traders. They see the market is flat. On a green dildo, they will look for exhaustion and a retrace. So if price comes, let's say, does this, as I said, range high deviation, they will want to short either somewhere around here, or they will look to short this back down to the range lows, right? And same for a dump. If price dumps all the way down to a range low support level, they will try to long it back up, right? So that's been it from my side. I really hope you learned something. The next video I'll try to cover more price action concepts, but this is really important so you know how I actually approach the market and how I would like to teach you moving forward. Thank you for watching.